For a look at how tech is performing in all of this, we're joined this morning by Credit Suisse head of global internet investment banking, Bob Peck, here at Post 9. Bob, good to have you back.
Thanks for having me.
Interesting. I'm looking at the biggest losers on the NDX today.
Yeah.
Micron, Netflix, Nvidia. I mean, they're all stocks with 100%, 80% gains for the year or year on year. So is today about valuation, or is it about fears of cross-border M&A getting huge obstacles?
We get a lot of questions on valuation, and when you think about tech in general, trades around 12 times EBITDA. That's up a little bit versus historically around 11 times or so. I think the really interesting way to look at it, though, and look at the valuation of tech, is look at it on a PEG basis and look at it versus the other verticals. And when you line them up, say staples, discretionary, financials, et cetera, tech's about the 8th or so most rich vertical. So you've got 7 other in front of it. And in fact, when you look at tech relative to the market on a PEG basis, it's basically where it's been historically over the average. So I don't think tech valuations have really run away.
If Chinese investment in U.S. tech gets curbed or slowed down, what is the impact? Because, I mean, spend some time in Silicon Valley, look at who's buying real estate. You see a lot of Chinese investment coming in, at least on the ground level. But is that money going to significant places that will see a slowdown that could eventually trickle through to the market if that happens? You
obviously could have an impact, and you're seeing that with investors as they're trying to assess it today. And quite honestly, over the last 6 quarters or so, they've been trying to gauge the impact of this. If you look at tech M&A has been down partially from 15 and 16 because of that anticipation, knowing there are some regulatory issues that Chinese companies will have to handle. However, having said that, don't forget all the other big pockets of capital that are out there that can step in and fill some of that void. Don't forget the largest fund out there, SoftBank fund, is making very large investments. So I think you'll see other pockets of capital step in if there's any sort of disruption.
It doesn't sound like you believe that that's going to throw cold water on deal making within Silicon Valley and within the tech sector in general.
You know, I don't. In fact, if you look at Q1 for global M&A, it was one of the best quarters that we've had, in years. So it was fantastic. Tech in Q1 was up about 30% versus last year, and on par with the great years we had in Q1 of 15 and 16. So you're really seeing it push through this. And I think a lot of that's because all these innovative themes are coming out, whether it's ambient technology, autonomous, machine learning, AI. There's all these great investable themes that a lot of these big companies and non-tech companies want to be a part of and don't have run by them.
So are you getting the sense from tech executives that they too are willing to push through this sort of short-term valuation pain, price action pain, in return for freedom on the Chinese having forced JVs or stealing IP?
Yeah, I think when we talk to executives, they're very much looking not at the short-term prices and the impacts near term. They're looking longer term, especially some of these really big mega trends they know they can't miss out on, or geographic trends as well. You saw even Walmart recently make a big move in India, right? Realizing that was a huge market they had to be a part of. So I think you're seeing these executives think longer term, and their boards are supporting them thinking through near-term valuations.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.